What's up, everybody? Welcome to Heresy Financial. My name is Joe Brown. Recently, I've gotten a few questions about beta slippage because in a recent video, I talked about it and I kind of briefly mentioned beta slippage as being a reason why I like to stay out of a few funds other than using them for a few very specific and short-term purposes. And so I like to explain, because I got some questions about it, wanted to explain what beta slippage is and how it can cause you through the use of these funds to lose money and to become unprofitable on a trade, even if what you thought was going to happen actually happens. So for instance, if you believe the S&P 500 is going to go down, and so you use an inverse ETF to bet on the market going down, you can still lose. And the fund that you bought that is supposed to be an inverse of the S&P 500, that fund can actually go down along with the S&P 500 going down, even though it's not designed to do that. You can still lose money that way because of something called beta slippage. So I'm going to explain what beta slippage is and how that works. Ready? Let's dive in. All right, so beta slippage. The first thing to understand is that ETFs are derivatives. So what is a derivative? A derivative is simply something whose value is derived from something else, which is usually called the underlying. So options are derivatives because their value is determined based on what the stock is doing that they are an option on. Futures are derivatives. ETFs are derivatives because their value is derived from the value of whatever's in their portfolio. So mutual funds are as well. Now, it's possible to have multiple derivative layers as well. So what that means is that you can have an ETF whose portfolio is made up of derivatives. Not only that, what if you're trading options on an ETF, and that ETF, its portfolio is made up of futures, which are derivatives. So you could be trading derivatives of a derivative of derivatives. Now, the way I like to visualize what a derivative is tubing on a boat, on a lake. So you've got your boat pulling you along and, you're in a tube. Now, the boat's going to take a turn and it'll take a little bit of time for that momentum or that inertia change to catch up to you, and then it will move you. So there's, number one, a lag with derivatives, and number two, there's a magnitude difference with derivatives. Okay, let's do a thought experiment. Let's say you enter into an investment and it starts off at $100 per share. Now, let's say you have a bad day in the market and it drops by 20%. What is the new price per share? $80. Correct. Now, let's say the next day you have a great day in the market and it goes up by 20%. Now, what is the price per share? Yesterday you went down by 20%, so you went from 100 to 80. Today you go up by 20%. So what's your new price per share? It's not 100. You're only up to 96 because 20% of 80 is 16. So you're still down 4% from where you were the previous day. Now, the order doesn't matter. If you were to go up by 20% first and go from 100 to 120, and then you were to go down by 20% from 120, you still end at exactly 96 because 20% of 120 is 24. So if you have something that every day alternates, let's say between 10% up and then 10% down. This is arbitrary, but let's say that happens. Go up 10%, down 10%. Every day you do that back and forth. Eventually, you get to zero. Well, you approach zero because it's logarithmic. You can't actually get to zero by going down 10% at a time. But still, you get my point. It just goes down. Okay, you say, so what does that have to do with these ETFs? Well, there are some funds, inverse funds, where they're the inverse of whatever underlying they're tracking. Or number two, maybe they're leveraged funds. These ones get hit really hard with it. Or maybe they're funds that purely get their tracking through the use of futures, or a majority of their tracking comes from futures. The use of derivatives and the use of leverage and the structure to have an inverse correlation to the underlying, these can implement a beta slippage onto the products that you're investing in or trading in. Because if I have an ETF that is designed to just double whatever the underlying does for that day, what happens every day if that underlying kind of doesn't really move that much? It goes up a little, down a little, up a little, down a little. Well, every time it goes up a little and down a little, my fund will slowly start to underperform because every time it's doing the exact percentage just multiplied. And so if my underlying goes up by 1%, my leverage goes up by 2%. Then if my underlying goes down by 1%, my leverage goes down 2%. And so over time, compared to the underlying, I will underperform. That's what beta slippage is. It's severely underperforming over time, the underlying. And then after a while of doing that, even if the underlying has, a 10, 15, 20, 30% spike, if you've already lost 20, 30, 40% in that derivative, in that leveraged fund or that inverse fund due to that beta slippage happening, it won't matter if you get a 50% spike because that won't even bring you back up to par. Now you might be wondering, okay, well this is terrifying. How do I know that the fund that I'm using, the ETF that I'm choosing, doesn't have this associated with it? Well, there's a very, very, very easy way to test initially to see if there might be a factor like this happening to the ETF that you're using. Look at a chart from the inception of the fund. If the chart just does this, and there's lots of reverse stock splits along the way, it's probably not a good long-term play. ETFs like UVXY, whose underlying is the VIX, the volatility index, or a fund like SQQQ, which is short the NASDAQ. Funds like this, you can see they just drop and drop and drop and drop and drop. And you'll notice there's a lot of reverse splits along the way because if you approach a per share price of $1 or 50 cents, that's going to severely eliminate who is using that to trade with and to invest in. So they do a reverse split to bring that price back up to, $10, $20, $30, $40, $50 per share, knowing that over time, the value bleeds out. And it's because these funds are not designed for long-term investing. They're designed to track short-term plays. And so they're designed for use by day traders or at the very most like short-term swing traders. Because you might see a rally in one of these things for, a couple of weeks at a time, like you saw from late February to late March of this year, 2020. So you might see periods of time where they do really well because that's what they're designed to do. If you would have bought this, 6 months earlier, even that aggressive of a move wouldn't have been enough to make up for all of the decay, all of the bleeding out of value that this thing has experienced over time. So that's beta slippage. Just be aware of it. The easiest way to check to see if some fund's value has just been bleeding out over time through something like this happening, just look at a long-term chart to see what it looks like. And if there's reverse splits and it just does this, down and to the right, that's a good indication that this is not designed for long-term investing. As always, I really appreciate you guys. Thank you so much for watching. Have a great day.